The cost of healthcare continues to rise. To make it more affordable, you must get the most from your benefits, be strategic, and cut costs wherever possible. This podcast will review 7 ways to reduce healthcare expenses so you and your wallet stay healthy. Welcome back, everyone. I appreciate you joining me for Money Girl episode 882. I'm Laura Adams, an award-winning author, finance spokesperson, money speaker, founder of The Money Stack, a Substack newsletter, and host of Money Girl with over 43 million downloads. If you're getting value here, we would love for you to subscribe and consider submitting a 5-star rating or review. And if you have a question or a comment for the show, you can always leave it on our voicemail. Just call 302-364-0308. We'd love to hear from you. And you can also send an email and sign up for the free Money Stack newsletter when you visit lauradadams.com. Okay, let's just get right into the 7 ways to cut healthcare costs. Number 1 is to use healthcare subsidies. If you don't get health insurance through an employer or you're self-employed, getting coverage through a federal or state exchange, known as the Affordable Care Act Marketplace or ACA Marketplace, can be an affordable option. Depending on your income and family size, you may be eligible for a healthcare subsidy that reduces your monthly premium. In most states, open enrollment for ACA health plans typically runs from November 1 to January 15. Outside that window, you can sign up or change coverage anytime if you experience a life event that qualifies for a special enrollment period, such as having a child, getting married, or relocating to another state. Tip number 2 is to maximize your health plan benefits annually. Whether you get health insurance through an employer or on your own, its benefits and deductibles get tied to an annual schedule. So that means you've got to pay attention to the calendar to maximize it. Your deductible is the amount you pay for covered healthcare expenses before your insurance begins. For instance, let's say you have a $3,000 deductible. That means you've got to pay the first $3,000 of covered services each year. If you reach your health insurance deductible, your insurance covers additional costs through the end of the year, with you typically only being responsible for a copayment or a copay. A copay is a flat fee you pay each time you visit a doctor or fill a prescription. So if you have enough healthcare expenses to surpass your deductible, let's say by September, and you need more covered medical services or products, be sure to get them before the end of the year. If you wait until the following year, your deductible resets on January 1st, and you'll have out-of-pocket costs again until you reach your deductible for that year. So if you only remember one tip from this podcast, once you reach your annual deductible, your best strategy is to have your insurer cover as much of your necessary medical expenses as possible. Tip number 3, use telehealth when possible. Telehealth services became essential during the pandemic. Federal and state governments incentivized insurers to expand their telemedicine capabilities, and that's a win-win for health carriers and policyholders. Having a virtual visit with a doctor by video chat or phone can save a lot of time and money. I've done telehealth visits and, they've worked out great. While a telehealth appointment won't be possible for many situations, if you have common ailments like a cold, flu, or allergies, it can be more convenient and cost-effective than going to a doctor's office. You can also use telemedicine for mental health counseling, nutrition advice, and medication consultations. Tip number 4. Contribute to a flexible savings account or FSA at work. If your employer offers an FSA, you can make pre-tax contributions through payroll deductions. For 2024, eligible employees and their employers can contribute up to $3,200 to a healthcare FSA. That limit is going up. It's going to increase to $3,300 for 2025. If you spend FSA funds on qualified expenses, they're never taxed. However, there is an annual spending deadline. deadline, so it's known as a use it or lose it rule. You have to empty the account annually or only carry a small balance like up to $600 or $640 into the following year. Now, there's another type of FSA called a dependent care account. That has a $5,000 contribution limit. It's exclusively for child care expenses, like daycare and after-school care for children under 13. Plus, if you claim an older person, like a parent, as a dependent on your taxes, the funds can be spent on their care as well. Tip number 5. Contribute to a health savings account, or HSA. If you enroll in an HSA qualified high deductible health plan at work or on your own, you can contribute to an HSA. They're one of the most tax-friendly accounts on the planet. You can make pre-tax contributions and then spend the funds on qualified medical expenses entirely tax-free. For 2024, you or anyone else can contribute up to $4,150 when you have an individual health plan, or $8,300 with a family plan. And for 2025, the limits will increase to $4,300 or $8,550. And after age 55, you can contribute an additional $1,000 each year for either type of health plan. Those are the total limits, including amounts contributed by someone else, like an employer or a relative. A high-deductible health plan may be a good choice depending on your health needs and your expected annual medical expenses. You can take distributions from an HSA to pay a long list of medical costs, even if your insurance doesn't cover them. That might include dental care, prescription eyeglasses, chiropractic, or acupuncture. If you spend HSA funds on qualified medical expenses, they never get taxed. Consider this. If your average income tax rate is, let's say, 25%, using your HSA gives you a 25% discount on all out-of-pocket medical expenses because they're tax-free. However, if you spend money in an HSA on non-qualified expenses, withdrawn amounts are subject to income tax plus an additional 20% penalty. So it's not wise to put money in an HSA that you might need for everyday living expenses. If you change insurance and you no longer have an HSA-qualified health plan, you won't be eligible to make new contributions. Still, you can spend your existing balance on qualified medical expenses for you and your family. Unlike an FSA, there's no spending deadline with an HSA. Your funds can accumulate indefinitely without penalty. Here's a quick review of the tax advantages of an HSA. You make tax-deductible contributions that reduce your taxable income. You get tax-free investment growth. And you can make tax-free withdrawals to spend on various qualified healthcare expenses. These terrific benefits cut your tax bill and maximize your healthcare buying power. Plus, after you reach age 65, funds in your HSA can be spent on non-qualified expenses without that steep 20% penalty. Therefore, maxing out an HSA each year is a really clever way to boost your retirement savings. Tip number 6, claim medical tax deductions. You can deduct various unreimbursed healthcare expenses when you itemize deductions instead of taking the standard deduction on your tax return. They include healthcare paid for yourself, your spouse, and dependents, including health insurance premiums, unless an employer already excludes them from your taxable income. There's a very long list of medical expenses that you can deduct, including acupuncture, chiropractic, contact lenses, mental health treatment, weight loss programs when recommended by a doctor to treat a medical condition like obesity or hypertension, and transportation to medical care. You can review the very long, complete list of deductible medical expenses in IRS Publication 502 called Medical and Dental Expenses, and I'll put a link to it in the show notes. Note that the deductible expenses don't include costs to improve your general well-being or appearance, like a gym membership, vitamins, or cosmetic surgery. But there are many expenses that you might not realize are deductible. For 2024, the medical deduction applies to allowable expenses exceeding 7.5% of your adjusted gross income, or AGI. For example, if your AGI is $50,000 and your unreimbursed medical expenses are $5,000, you could deduct the amount over $3,700. So that's 7.5% of $50,000. That comes to $1,250. But if your medical expenses are less than 7.5% of your AGI, you cannot deduct them. Note that you can't double dip by paying a medical cost using an FSA or an HSA and claiming it as a deduction on your taxes. You must choose one tax benefit or the other. And number 7, plan your health care. Taking advantage of your health plan's free preventative services like annual physicals, mammograms, prostate screenings, dental cleanings, and eye exams is essential. Routine health screenings and checkups can catch health problems early when they may be more easily treated and less expensive. If you don't schedule those visits, it's like simultaneously throwing money away and neglecting your health. Also, you'll save time and money by going to an urgent care clinic instead of an emergency room at a hospital. Of course, if you genuinely need emergency care, go there or call an ambulance. When you have time to plan your health care or you need to schedule a procedure, ask your doctor if you can have it in an outpatient clinic, which is often less expensive than having the same treatment in a hospital. Also, choose in-network providers when your insurance covers them because you'll pay a lot less. The best way to cut your health care is to stay as healthy as possible by managing your weight, eating well, exercising regularly, and getting preventive checkups. You'll likely feel your best and pay less for medical care for the rest of your life. So schedule those checkups and get the most out of your insurance before the end of the year. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a Quick and Dirty Tips podcast. I want to thank our terrific team. Steve Rickyberg audio engineers the show. Brandon Gachus is our director of podcasts. Holly Hutchins is our digital operations specialist. Morgan Christensen is our advertising operations specialist. Davina Tomlin is our marketing and publicity associate. And Nathaniel Hoops is our marketing contractor.